April 1st, 1976, three young men started a company in America. One of those guys was Steve Jobs, and that company is what we know today as Apple. 9 years later, in 1985, Jobs was fired from Apple. I mean, how can you fire someone from a business that was started by him? Well, in a joint stock company, it is possible. Because in this form of organization, the business ownership and the management are two separate things. So the joint stock companyಯಲ್ಲಿ ಓನರ್ಸೇ ಬೇರೆ, ಆ ಕಂಪ್ನಿನ ಮ್ಯಾನೇಜ್ ಮಾಡೋರೇ ಬೇರೆ. ಸೊ ಈ ಓನರ್ಶಿಪ್ನ ನಾವು ಹೇಗೆ ಡಿಸೈಡ್ ಮಾಡ್ತೀವಿ ಅಂದರೆ ಶೇರ್ ಕ್ಯಾಪಿಟಲ್. ಸೊ ಶೇರ್ ಕ್ಯಾಪಿಟಲ್ ಬಂದು ಒಂದು ಪ್ರೀಡಿಟರ್ಮಿನ್ ಅಮೌಂಟ್ ಡಿವೈಡೆಡ್ ಇಂಟು ಸರ್ಟನ್ ನಂಬರ್ ಆಫ್ ಯೂನಿಟ್ಸ್ ಅಂತ ಹೇಳ್ಬೋದು. ಸೊ ಒಂದೊಂದು ಯೂನಿಟ್ನ ಶೇರ್ ಅಂತೀವಿ. ಸೊ ಈ ಶೇರ್ಸಲ್ಲಿ ಎಷ್ಟೊಂದು ಟೈಪ್ಸ್ ಇದ್ದಾವೆ, ಶೇರ್ಸ್ನ ಹೇಗೆ ಇಶ್ಯೂ ಮಾಡ್ತೀವಿ, ಇಶ್ಯೂ ಮಾಡೋ ಸಂದರ್ಭಗಳೇನು, ಇಶ್ಯೂ ಮಾಡಿದಾಗ ಆಗೋ ಪರಿಣಾಮಗಳೇನು, ಹಾಗೂ ಇದನ್ನು ಅಕೌಂಟ್ಸಲ್ಲಿ ಹೇಗೆ ಟ್ರೀಟ್ ಮಾಡ್ತೀವಿ, ಇವೆಲ್ಲದನ್ನು ಈ ವಿಡಿಯೋದಲ್ಲಿ ನೋಡೋಣ. ಹಾಯ್ ಹಲೋ ನಮಸ್ಕಾರ, ಇನ್ನೊಂದು ಲೆಸನ್ಗೆ ಸ್ವಾಗತ. ದಿಸ್ ಇಸ್ ಬಿನಾಯ್. ನೀವು ಇದನ್ನು ನೋಡ್ತಿರೋದಕ್ಕೆ ಹಾಗೂ ನಿಮ್ಮ ಸಮಯಕ್ಕೆ ತುಂಬ ಥ್ಯಾಂಕ್ಸ್. ನೀವಿನ್ನೂ ಸಬ್ಸ್ಕ್ರೈಬ್ ಮಾಡಿಲ್ಲ ಅಂದರೆ ಈಗಲೇ ಸಬ್ಸ್ಕ್ರೈಬ್ ಮಾಡಿ ಹಾಗೂ ಆ ಬೆಲ್ ಐಕಾನ್ನ ಕ್ಲಿಕ್ ಮಾಡಿ. ಸೊ ನಾನು ಫ್ಯೂಚರಲ್ಲಿ ಆಗೋ ವಿಡಿಯೋ ನೋಟಿಫಿಕೇಶನ್ಸ್ ಎಲ್ಲ ನಿಮಗೆ ಬರುತ್ತೆ. ಸೊ ನಾನು ಹೇಳ್ದಂಗೆ ಜಾಯಿಂಟ್ ಸ್ಟಾಕ್ ಕಂಪ್ನಿಯಲ್ಲಿ ಓನರ್ಶಿಪ್ಪೇ ಬೇರೆ, ಮ್ಯಾನೇಜ್ಮೆಂಟೇ ಬೇರೆ. ಸೊ ಕ್ಯಾಪಿಟಲ್ನ ಕೊಡೋರೇ ಬೇರೆ ಹಾಗೂ ಆ ಬಿಸ್ನೆಸ್ನ ನಡೆಸೋರು ಅಂದರೆ ಮ್ಯಾನೇಜ್ ಮಾಡೋರೇ ಬೇರೆ. ಸೊ ಏನಕ್ಕೆ ಹೀಗೆ ಅಂತ ನೀವು ಕೇಳ್ಬೋದು. ದಟ್ಸ್ ಅ ಗುಡ್ ಕ್ವೆಶ್ಚನ್. ಸೊ ಹಿಸ್ಟ್ರಿ ಆಫ್ ಬಿಸ್ನೆಸ್ ಆರ್ಗನೈಸೇಷನ್ಸ್ನ ನೋಡೋಣ. ಸೊ ಹಿಂದಿನ ಕಾಲದಲ್ಲಿ ಯಾರಾದರೂ ಒಂದು ಬಿಸ್ನೆಸ್ ಮಾಡಬೇಕಂದ್ರೆ ಸ್ವಂತವಾಗಿ ಮಾಡೋರು, ಅಂದರೆ ಅವರೊಬ್ಬರೇ ಮಾಡೋರು. ಸೊ ದಟ್ ವಾಸ್ ಕಾಲ್ಡ್ ಸೋಲ್ ಟ್ರೇಡಿಂಗ್ ಕನ್ಸರ್ನ್. ಸೊ ಅವಾಗ ಏನಾಗಿತ್ತಂದರೆ ಯಾರೊಬ್ಬರೇನೋ ಮಾಡಬೇಕಂದ್ರೆ ಅವ್ರು ಸ್ವಂತವಾಗಿ ಮಾಡೋರು. ಅದರಲ್ಲಿ ಲಿಮಿಟೇಷನ್ಸ್ ಇದೆ, ಅಂದರೆ ಅವ್ರು ಒಬ್ಬರೇ ನೋಡ್ಕೋಬೇಕು, ಅವರೊಬ್ಬರೇ ಹಣ ಹಾಕಬೇಕು, ಬಿಸ್ನೆಸ್ನ ಮ್ಯಾನೇಜ್ ಮಾಡಬೇಕು, ಇಂಥ ಪ್ರಾಬ್ಲಮ್ಸ್ ಇತ್ತು. ಸೊ ಹೋಗ್ತಾ ಹೋಗ್ತಾ ಏನಾಯ್ತಂದರೆ ಒಬ್ರಿಗಿಂತ ಹೆಚ್ಚಿದ್ರೆ ಅವ್ರಿಗಿನ್ನ ಅನುಕೂಲವಾಗಿರುತ್ತೆ ಅಂತ 2, 3, 4 ಜನ ಹಂಗೆ ಸೇರಿಕೊಂಡು ಬಿಸ್ನೆಸ್ ಮಾಡೋಕ್ಕೆ ಶುರು ಮಾಡಿದ್ರು. ಸೊ ಈಗೇನಾಯಿತು, 4 ಜನ ಹಣ ಹಾಕ್ತಾರೆ ಪ್ಲಸ್ 4 ಜನನೂ ಬಿಸ್ನೆಸ್ನ ಮ್ಯಾನೇಜ್ ಮಾಡ್ತಾರೆ. ಸೊ ಇದು ಇನ್ನೂ ಚೆನ್ನಾಗಿ ಕೆಲಸ ಮಾಡೋಕ್ಕೆ ಶುರುವಾಯಿತು, ಪ್ಲಸ್ ಇನ್ನೂ ಜಾಸ್ತಿ ಜನಕ್ಕೆ ಸರ್ವಿಸ್ ಪ್ರೊವೈಡ್ ಮಾಡೋ ಥರ ಆಯಿತು. ಹಾಗೆಯೇ ಹೋಗ್ತಾ ಹೋಗ್ತಾ ಏನಾಯಿತು, ಇದು ಒಂದು ಲೀಗಲ್ ಫಾರ್ಮ್ ಆಫ್ ಬಿಸ್ನೆಸ್ ಆಗಿ ಅದಕ್ಕಂತಾನೆ ಒಂದು ಕಾನೂನು ಬಂದಿದೆ ಈಗ, ಪಾರ್ಟ್ನರ್ಶಿಪ್ ಆ್ಯಕ್ಟ್ ಅಂತ. ಬಟ್ ಪಾರ್ಟ್ನರ್ಶಿಪ್ಪಲ್ಲಿ ಕೂಡ ಲಿಮಿಟೇಷನ್ಸ್ ಇದೆ. ಸೊ ಮೋಸ್ಟ್ ಇಂಪಾರ್ಟೆಂಟ್ ಲಿಮಿಟೇಷನ್ ಬಂದು ದ ನಂಬರ್ ಆಫ್ ಮೆಂಬರ್ಸ್. ಸೊ ಪ್ರೀವಿಯಸ್ಲಿ ಏನಾಗಿತ್ತಂದರೆ ಬರೀ 20 ಜನನೇ ಒಂದು ಪಾರ್ಟ್ನರ್ಶಿಪ್ಪಲ್ಲಿ ಮ್ಯಾಕ್ಸಿಮಮ್ ನಂಬರ್ ಆಫ್ ಮೆಂಬರ್ಸ್ ಬಂದು ಬರೀ 20 ಮೆಂಬರ್ಸ್ ಅಂತ ಇತ್ತು. ಬಟ್ ಈಗ ಸ್ವಲ್ಪ ರಿವೈಸ್ ಮಾಡಿ ಆ ನಂಬರ್ನ 50ಗೆ ಇನ್ಕ್ರೀಸ್ ಮಾಡಿದ್ದಾರೆ. ಸೊ ದ ಮ್ಯಾಕ್ಸಿಮಮ್ ನಂಬರ್ ಆಫ್ ಮೆಂಬರ್ಸ್ ಇನ್ ಅ ಪಾರ್ಟ್ನರ್ಶಿಪ್ ಇಸ್ 50. ಬಟ್ ಸ್ಟಿಲ್ ಅದು ಕೂಡ ಒಂದು ಲಿಮಿಟೇಷನ್. ಸೊ 50 ಜನಕ್ಕಿಂತ ಹೆಚ್ಚು ಜಾಸ್ತಿ ಒಂದು ಬಿಸ್ನೆಸ್ಸಲ್ಲಿ, ಅಂದರೆ ಒಂದು ಪಾರ್ಟ್ನರ್ಶಿಪ್ ಬಿಸ್ನೆಸ್ಸಲ್ಲಿ ಇರೋಕ್ಕಾಗಲ್ಲ. ಸೊ ಅದು ಒಂದು ಕಾರಣ ಇಂಥ ಜಾಯಿಂಟ್ ಸ್ಟಾಕ್ ಕಂಪ್ನಿ ಫಾರ್ಮ್ ಆಫ್ ಬಿಸ್ನೆಸ್ ಶುರು ಆಗೋಕ್ಕೆ. ಆದರೆ ಇನ್ನೂ ಮುಖ್ಯವಾದ ಕಾರಣ ಏನಂದರೆ, ಈಗ ಕೆಲವರು ಇರ್ತಾರೆ, ಅವ್ರಿಗೆ ಬಂದು ಬಿಸ್ನೆಸ್ ಮಾಡೋ ಐಡಿಯಾಸ್ ಇದೆ, ಆದರೆ ಅವ್ರಿಗೆ ಆ ಬಿಸ್ನೆಸ್ಗೆ ಹಾಕೋ ಹಣ ಇಲ್ಲ, ಅಂದರೆ ಅವ್ರ ಹತ್ರ ಕ್ಯಾಪಿಟಲ್ ಇಲ್ಲ. ಅಟ್ ದ ಸೇಮ್ ಟೈಮ್ ಈ ಕಡೆ ಇನ್ನೂ ಕೆಲವು ಜನ ಇರ್ತಾರೆ, ಸೊ ಅವ್ರಿಗೆ ಬಂದು ಬಿಸ್ನೆಸ್ ಮಾಡೋ ಐಡಿಯಾಸ್ ಇಲ್ಲ, ಬಟ್ ಅವ್ರ ಹತ್ರ ಹಣ ಇದೆ. ಸೊ ಅವ್ರು ಬಂದು ಕ್ಯಾಪಿಟಲ್ ಬೇರೆಯವ್ರಿಗೆ ಕೊಡೋಕೆ ರೆಡಿ ಆಗಿದ್ದಾರೆ. ಸೊ ಇವ್ರನ್ನ ನಾವು ಇನ್ವೆಸ್ಟರ್ಸ್ ಅಂತ ಕರಿತೀವಿ. ಸೊ ಈಗೇನಾಯಿತು, ಈ ಕಡೆ ಇರೋರಿಗೆ ಹಣ ಇದೆ ಆದರೆ ಬಿಸ್ನೆಸ್ ಐಡಿಯಾಸ್ ಇಲ್ಲ, ಇಲ್ಲಿರೋರಿಗೆ ಬಿಸ್ನೆಸ್ ಐಡಿಯಾಸ್ ಇದೆ ಆದರೆ ಹಣ ಇಲ್ಲ. ಸೊ ಇವರಿಬ್ಬರು ಸೇರ್ಕೊಂಡು ಏನಂದ್ರೆ ನಾನು ನಿನಗೆ ಹಣ ಕೊಡ್ತೀನಿ, ನೀನು ಬಿಸ್ನೆಸ್ ಮಾಡು, ಸೊ ಬರೋ ಲಾಭದಲ್ಲಿ ನಾನು ತೊಗೊಳ್ತೀನಿ ನನ್ನ ಭಾಗ ಅಂತ. ಸೊ ಈಗೇನಾಯಿತು, ಓನರ್ಸೇ ಡಿಫ್ರೆಂಟ್ ಆದರೂ ಮ್ಯಾನೇಜ್ಮೆಂಟೇ ಡಿಫ್ರೆಂಟ್ ಆಗೋಯ್ತು. ಸೊ ಹೀಗೆ ಶುರುವಾಗಿದ್ದೆ ಜಾಯಿಂಟ್ ಸ್ಟಾಕ್ ಕಂಪನೀಸ್. ಸೊ ನಾನು ಹೇಳ್ತಿದ್ದಂಗೆ ಒಂದು ಜಾಯಿಂಟ್ ಸ್ಟಾಕ್ ಕಂಪ್ನಿಯಲ್ಲಿ ಆ ಓನರ್ಶಿಪ್ನ ಡಿಸೈಡ್ ಆಗೋದು ಬಂದು ಶೇರ್ ಕ್ಯಾಪಿಟಲ್. ಸೊ ನ್ಯಾಚುರಲಿ ಶೇರ್ ಕ್ಯಾಪಿಟಲ್ ನೀಡ್ಸ್ ಅ ಲಾಟ್ ಆಫ್ ಅಟೆನ್ಷನ್ ವೆನ್ ಇಟ್ ಕಮ್ಸ್ ಟು ದಿ ಅಕೌಂಟಿಂಗ್ ಟ್ರೀಟ್ಮೆಂಟ್. ಸೊ ಇದು ಬಂದು ಒಂದು ತುಂಬ ಇಂಪಾರ್ಟೆಂಟ್ ಲೆಸನ್. ಗ್ರ್ಯಾಬ್ ಯುವರ್ ಪೆನ್ ಆ್ಯಂಡ್ ಪೇಪರ್ ಆ್ಯಂಡ್ ಟೇಕ್ ನೋಟ್ಸ್ ಆಸ್ ವಿ ಆರ್ ಡೂಯಿಂಗ್ ದಿಸ್. ಇದು ನಿಮಗೆ ತುಂಬ ಹೆಲ್ಪ್ ಆಗುತ್ತೆ. ಸೊ ಲೆಟ್ಸ್ ಸ್ಟಾರ್ಟ್. Okay, so as I already told you, owners and managers in a company are separate. So shareholders are the owners, and then we have board of directors. They manage the company. So what happens in the company is these people called shareholders contribute money to the company for which they are issued shares. So they contribute the share capital to the company. And then the company is managed by these people called the board of directors. So board of directors, they oversee the company. They decide what happens and, they take all the major decisions. And these board of directors are obviously elected by shareholders. So shareholders are the owners, so naturally they decide who the board of directors will be. Now, the Companies Act of 2013 is like the framework, or it forms the guidance. It gives the guidance to the board of directors in managing the company. So now let's look at the types of companies Now, companies can be classified either on the basis of the liability of its members or on the basis of the number of members. Okay, so first let's look at the liability. So under this category, there are three types of companies. So first is companies limited by shares. So what this means is, in this case of companies, the liability of the shareholders is only up to the extent of any unpaid amount on their shares. So let's say a share cost 100 rupees and shareholders have paid only 80 rupees. So in that case, their liability is going to be only the remaining 20 rupees. If they have paid the whole amount, which is 100, then they'll absolutely have no liability. So in case the company liquidates, they will not have to pay from their private assets. Coming to the next category, which is companies limited by guarantee. So in this case, what happens is the shareholders will agree a certain amount, or they will guarantee a certain amount. So in case of the company being liquidated, they will have to contribute the amount that they have guaranteed. So that will be the liability of the shareholders. So whatever they guaranteed should be contributed. Okay. And finally, we have unlimited companies. So in this type of companies, what happens is the shareholders' liability is unlimited. So in case the company cannot pay its debts from its own assets, the shareholders will have to contribute their private assets to repay the debts. Naturally, nobody will want to become members in such companies because, who wants to pay money from their private assets just because the company does not do well, right? So that's why these companies are not found in India, though the Companies Act actually permits the existence of such companies. All right, now let's move to the next category, which is on the basis of members. So there are three kinds again here. So firstly, we have public companies. So public companies are those companies which are listed on the stock exchange. So they are also known as listed companies. So stock exchange, it's a vast concept, but just to keep things simple, stock exchange is nothing but a market where shares of companies are bought and sold. So a public company's shares are listed on the stock exchange, which means anybody can buy the shares of a public company. So anybody can become a shareholder in a public company. But a private company is a company, the shares of which are not listed on a stock exchange. So in case of a private company, the management will decide as to who becomes the shareholder. So they'll decide who should the investors be in the company. Okay, so anybody cannot become, the management just decides who they will issue the shares to. But in case of public company, anybody can become shareholders. So existing shareholders can sell their shares to new people, or when the company issues shares in the beginning, as a new company, anybody can subscribe to those shares. So that's a public company. And private company, as I already told you, it's private. Not everybody can become members. And then lastly, we have one-person company. So one-person company is a company that has only one person as a member. Okay, so that's it's pretty much obvious in the name itself, and it has a few more conditions, but for now, just keep that in mind and that should be fine. But mainly we'll be concerned with public companies, but you just have to know about a private company as well. Now let's look at the categories of share capital. So there are different terms that you should be familiar with. Firstly, it's the authorized capital. So what authorized capital means is the maximum capital that the company is authorized to raise. So this will be stated in the Memorandum of Association of the company. So two important documents for a company are Memorandum of Association and Articles of Association. So MOA states the authorized capital. So this capital is also known as registered capital, okay? So for example, let's say the authorized capital is 4 lakhs. So that is 4,000 shares at rupees 100 each. So a company cannot raise capital exceeding 4 lakhs. So it can choose to raise less than that, or it can raise 4 lakhs in different issues, like in multiple issues, but it cannot raise more than 4 lakhs. So that's the authorized capital. Okay. Now, out of this authorized capital, a company may choose to issue only part of it. So it can just issue a part of that. So that is, out of 4 lakhs, it can choose to issue just 3 lakhs. So in that case, that 3 lakhs is the issued capital. So what's remaining? 1 lakh. So that 1 lakh will be the unissued capital. Okay. Now, it's issued capital. So out of whatever it has issued, the whole thing may be subscribed, or just a part of it may be subscribed. Okay, so there's no guarantee that the whole 3 lakhs will be subscribed. So whatever is actually subscribed for by the public will be called as the subscribed capital. Okay, so subscribe in the sense just purchase or buy the shares. So once the public has subscribed, the company will decide to call the remaining amount that has to be paid on the shares. So in the next few minutes, we'll also see about how shares are issued. So in that, you will know the different amounts that are or the different stages in the issue. So with that, it'll become clear. But for now, just keep in mind that amounts are called in different installments. So whatever has been called by the company is called as called up capital. So out of 100, for example, it may call up to 80 rupees. So in that case, 80 rupees is the called up capital. Now, out of that 80 rupees, the whole 80 might not be paid by the shareholders. So they may have paid just 60 rupees for now. So in that case, 60 rupees will be the paid up capital. So paid up capital is that part of the called up capital which has actually been received by the company from the shareholders. Okay, so naturally, if the shares are fully paid, which means out of the 100, if the whole 100 rupees has been received by the company, then in that case, they are called fully paid shares. Out of that 100, let's say just 75 has been received by the company. So in that case, they are called not fully paid shares. So out of the 3,000 shares that were issued, let's say 1,500 are fully paid. So in that case, 1,50,000 is fully paid. On the other hand, the remaining 1,500 shares are paid only up to 75 rupees. So they are paid only up to 112,500. So in that case, the remaining 37,500 will be called as calls in arrears. So this will also be shown under the share capital. Okay, now let's look at the types of shares. So firstly, as I said, the share capital of a company is divided into a small number of units, and each unit is called a share. So a share is a part of the share capital of the company. Now, there are two main types of shares. Firstly, we have equity shares, which are also known as ordinary shares, and then we have preference shares. So preference shares are those shares which have a priority or preference over the other shares, which are the ordinary shares. Okay, so the preference is in regards to the payment of dividend, repayment of capital. Okay, so when the company makes profits, the preference shareholders will get their dividends first. So preference shares will usually have the percentage stated, for example, 5% preference shares or 6%. So that will be the dividend for them. So no matter how much profit the company makes, the dividend is fixed. And they'll obviously get the dividend first, and then it'll be paid to the equity shareholders. And let's say the company liquidates for some reason, the preference shareholders will get their capital repaid first, and only after that, if any capital is remaining, that will be used to repay the equity shareholders. There are different kinds of preference shares, like they could be participating or not participating, cumulative, non-cumulative. So participating means it's just that, after they have received their dividend, let's say there is excess profits available, they may get a chance to participate. So that is participating. So that's just some extra information. But for now, just remember that preference shares are nothing but those shares which have a priority or preference over equity shares. Now, equity shares are ordinary shares. So for these guys, the dividend varies. So if the company makes more profit, they're going to get more shares. More dividend. If it makes less profit, less dividend. And if there's no profit at all, then they're not going to get any dividends. So they have their own benefits and risk, and these have their own benefits and drawbacks as well. And of course, if the company liquidates, first the capital will be paid to the preference shareholders, and only after that, if anything remains, that will be used to repay the equity shareholders. Okay, so now let's look at the share issue process. So when a company is on the verge of being formed and it has to raise its capital, it will first issue what is known as a prospectus. So prospectus is nothing but an invitation to the public to subscribe to the shares of this newly formed company. Okay, so the prospectus will contain important information like the number of shares and how much each share is going to cost. So let's say, for example, a new company is issuing 10,000 shares at rupees 10 each. So this will be shown in the prospectus, and this is issued to the public. Okay, now it's gone to the public, and the public responds by applying. So let's say some people want to buy the shares. So all they'll do is they'll just apply for the shares of this company, and with the application amount should be paid. So as I said, the whole 10 rupees will not be collected at once. So it will be broken down into different stages. So firstly, it will be the application stage. So in this case, let's say the company asks for just 5 rupees on application. So this 5 rupees should be paid by the shareholders when they're applying for the shares. Okay. Another important thing you have to keep in mind is minimum subscription. So minimum subscription is that much of money which, in the opinion of directors, is required for the company to function in the initial stages. So it can be money required for acquiring any property, or payment of preliminary expenses, or for working capital and things like that. So that much of minimum subscription should be received by the company, or that much of applications should be received. In case it does not receive, the company cannot go ahead with the issue of shares. It has to just refund whatever amount it has received. All right, now the company has received applications. Now, two things can happen. One is oversubscription and the second is undersubscription. Undersubscription is pretty simple and easy. So what it means is, let's say they issued an invitation for 10,000 shares, but only 8,000 shares were received. So in that case, it has received less applications than what was issued. So in this case, it will just allot shares to those 8,000 people and it will just go ahead. So that's done. Now, oversubscription is where it gets a little complicated. So oversubscription is a situation where more applications are received. So in this case, let's say 10,000 shares were invited for, but 12,000 or let's say 15,000 people applied for it. So now the company has to decide what it's going to do. So there are different methods or different decisions that the company can take. First is it can just reject the extra ones. So what that means is, out of the 15,000, it can just reject 5,000 applications and allot shares only to the 10,000 people. That's one thing, which is pretty straightforward. The second thing is what is known as pro rata allotment. So what this means is, now 15,000 people have applied for the shares, but the company is going to issue only 10,000 shares. So in this case, what it can do is it can proportionately allot shares. So what that means is, if someone applied for 3 shares, it can just allot 2 shares for them. So in this case, what's going to happen is all the applications are going to be honored. It's just that everybody won't get how much they applied for. So that is pro rata allotment. And the third is combination of the above two, and this is quite common. So the way this works is, let's say 15,000 were applied. Now what the company will do is it will reject 2,500. So the remaining applications are 12,500. For these 12,500, it's going to allot the 10,000 shares. So in this case, the ratio will be 5:4. So for every 5 shares applied, 4 shares will be allotted. Coming to the accounting treatment. So when application money is received, the company is receiving cash. So you will debit what comes in, which is bank. So share application money is received and it's treated like an income. So you'll credit incomes, right? So that's why you'll be crediting share application. And then the share application money should be closed by transferring it to share capital. So the way you'll close this credit balance is by debiting it. And then naturally share capital is created. And share capital is a liability. It will be shown on the liability side and it has a credit balance. So that's why you'll credit it. So in this case, what will happen is 5 rupees has been received. Let's say 10,000 shares have been applied for. So 5 into 10,000. So that will be 50,000 will be received by the company. So that will be 50,000 for all these entries. Now the next step in the issue of shares is allotment. So now the company has received applications for let's say 10,000 shares and 5 rupees per share has been received. So now the company will decide to allot the shares. So all those to whom the shares are allotted become shareholders, and then the allotment money becomes payable. So now let's say out of the 10 rupees, 5 was received for application and 3 is for allotment. So in this case, what happens is the accounting treatment will be share allotment debit to share capital. So you're debiting share allotment because it is a receivable. So it's like an asset to the company. So you'll debit that one. And naturally share capital is increasing by 3 rupees. So now let's say 10,000 shares. So that will be 3 into 10,000, 3 into 10,000, so 30,000. And then finally, when the allotment money is received, you'll debit bank account because you're getting cash. And then the share allotment account, because it's been received, it will be closed by crediting. Okay, so that's the third step. And then finally, we have what are known as calls. So a company will call the final amounts in these installments known as calls. So it has asked for 5 in application and 3 for allotment. So remaining 2 will be asked for in calls. So then the share becomes fully paid. Now, there are some things you have to keep in mind. Firstly, amount of any call should not exceed 25% of the face value. So in this case, the face value of share is 10 rupees, right? So any call should not be more than 2 rupees 50 paisa, which is the 25%. Okay, so that's one thing. So it should be less than 2 rupees 50 paisa. And the second thing is there should be at least 1 month between calls. So for example, let's say a share costs 100 rupees and there are 3 calls like 20 rupees each. So between those calls, there should be at least 1 month break. So if they call today, the next call should be only after 1 month from today. Okay. And the journal entry is pretty simple again. So it's just like allotment. So share first call becomes a payable. So that's why you'll debit it. Share capital increases. So you credit it. And then once you receive the amount, bank is debited. And then this share call will be credited. So what you have to keep in mind is the last call should always have this final call included. So in this case, there's just 1 call. So that's why it'll be share first and final. So let's say a share has 2 calls. So in that case, it'll be share first call. And then the next entry later will be share second and final call. Okay, so once this process is done, the shares become fully paid. So calls in arrears. So what this means is failure to pay call amount. Now let's say a company makes a call of 10 rupees. So then the journal entry is share call 10 to share capital. Now, if those people pay the amount, then what we are doing is we'll debit bank and then we'll credit the share call account just to close it. But in case they do not pay, then what we do is we create another account called calls in arrears. So this is debited because calls in arrears is an asset. We have to receive, the company has to receive. It's a receivable. And then this share call which has a debit will be closed by crediting. Now, some companies, they choose to not maintain this calls in arrears account. So in that case, they'll just leave it here. So this will usually be specified in case you're doing problems. It will be specified as to whether the company has calls in arrears or not. So based on that, you'll have to follow this. Okay, so usually interest must be paid for late payment. So the company makes a call and the shareholders don't pay. They pay at a later stage. In that case, they'll have to pay some interest as well, which will be predetermined. So when they pay, what happens is bank is debited because the company is receiving cash. So let's say the call is 10 rupees and the interest was 2 rupees. So the total receipt is 12 rupees. That will be debited. And then calls in arrears was 10. So now we have a debit balance here. So we'll close it because we have received the call. So it will be credited. And then the interest, which is again an income, will be credited to 2 rupees. Okay, so debit what comes in, close the asset, which is calls in arrears, and we credit all incomes. And that's why interest is credited. Okay, calls in advance. So this is nothing but receiving call amount before the call is made. So sometimes shareholders will choose to pay amount before the call is even made. So that is known as calls in advance. Now, any income received in advance is a liability to the company, right? That's why it will always have a credit balance. So you will debit bank because you're receiving money, and then calls in advance is credited because it's a liability. And then finally, when you call the amount, the journal entry naturally is share call debit to share capital. So share call account was created, which we saw in the previous step. Now that one will be closed by crediting it to calls in advance. Okay, so calls in advance is a liability here. Finally, when the call actually becomes payable, it will be closed by debiting it. So now the liability is closed. Now sometimes shares will be issued at an amount which is higher than the face value. So then they are said to be issued at a premium. Okay, so for example, let's say the face value is 10 rupees, but they're issued at 12. So the premium is 2. Now, you may ask why premium? So sometimes companies may have a reputation and people will be ready to pay a little more than the face value just to get those shares. So that's when shares will be issued at a premium. So now this is an income to the company and it will be shown under the reserves section of the balance sheet. Okay, now let's see how it is treated in the books of accounts. Firstly, bank is debited because you're receiving cash, right? 12 rupees, and then share application. So in this case, let's say the 2 rupees is included in the share application. So that will be shown in the first step itself, bank debit, share application credit. Now, when you're transferring this share application to the share capital, you will actually split it. So 10 rupees will go to share capital and the remaining 2 rupees goes to the premium, which is known as securities premium reserve. So share capital, which has a credit balance, will be debited, and then you will credit share capital to 10 rupees, which is the actual share capital, and then the remaining 2 rupees will go to the securities premium reserve, and that will be shown under the reserves and surpluses. Now, issue of shares at a discount. So sometimes shares will be issued at an amount which is less than the face value. That's when they are said to have been issued at a discount. Example, face value is 100, but they are issued at just 90. So in that case, the discount is 10. So in this case, what's happening is there is an expense to the company. So expenses are always debited, right? So that's why discount will be debited to 10, and the remaining debit goes to the bank, which is what the company is receiving. So it receives 90, remaining is the discount 10, and then it will be credited to the share capital account. So share capital will get the full credit of 100, which is the face value. What you have to keep in mind is only forfeited shares can be reissued at a discount. So in the next few minutes, we'll see about forfeited shares, and then it'll be clear. What you have to keep in mind is shares being issued for the first time cannot be issued at a discount. Okay, now let's look at forfeiture of shares. Forfeiture means cancellation of shares due to non-payment. So the company can make a call. Let's say it can fail to receive payment from the shareholders in any of the stages, like let's say allotment or at one of the calls. So in that case, the shares will be cancelled, and that's when they're said to have been forfeited. Now, what you have to do when there is a case of forfeiture is any entries relating to the issue of those shares should be reversed. Okay, so let's look at an example. Now, 100 shares of 10 each are forfeited for non-payment of 2. So 2 rupees is not paid, which means 8 rupees has been paid, right? But when the company makes its entries, naturally it would have given full credit to the share capital. So that's the full 10 rupees would have been credited to the share capital. So share capital's value is 100 into 10. So then what happens is that full 1000 share capital should be reversed. So share capital has credit balance, so you'll reverse it by debiting it 1000. Now, share call was not paid. So share call is an asset because you will create a receivable, right, by debiting it. But now we know that we are not going to receive it and we are going to cancel it. We are going to cancel the shares, so therefore that asset should also be cancelled. So 2 rupees for 100 shares is 200, and that asset account will be cancelled by crediting it. Okay, and then finally the remaining amount which was paid. So if 2 is not paid, it means 10 minus 2 is 8. So 8 has been paid. That 8 will be transferred to the forfeited shares account. Okay, and this will also be shown under share capital in the balance sheet. So this is like an income to the company because they don't have to give this money back to the shareholders. So they'll just have it in as a reserve. So balance of forfeited shares is shown as an addition to the total paid up capital of the company. Okay, so sometimes what will happen, shares would have been issued at a premium and then due to non-payment of calls, they may be forfeited. So in that case, the accounting treatment will slightly differ depending on whether the premium has been paid or not paid. Okay, so if the premium amount is received, the securities premium account is not touched at all. So the premium is just like an income to the company, so you don't have to worry about it. But if the premium amount is not received yet, it should be adjusted. So when we issue at a premium, we naturally create a reserve called securities premium reserve. So that is an income, like that's a reserve, sorry, and it will be shown on the balance sheet, right? So if we are not going to receive that amount, there's no point in showing it in the balance sheet. So therefore, what we have credited should be reduced. And the way you'll reduce it is by debiting it. If it's very confusing now, once you do the problems, you'll understand. But for now, just try to understand the logic. So it has a credit balance because it is a reserve, but the amount is not going to be received anymore. So we are going to reduce that reserve, and the way we reduce it is by debiting it. Okay, let's look at the example. 2 rupees is the premium and 10 rupees is the share capital or the face value. So now we are going to cancel it. we are going to forfeit the shares. So naturally share capital has a credit balance, so we'll cancel it by debiting it. So let's say 10 shares at 10 each, so that's why 100. And then the premium for those 10 shares is 20 rupees. So even that has a credit balance on the balance sheet. So now we are going to reduce it by debiting it. Now, shares forfeited, that is the face value. So that will be 100. So this new account is created, just like how we did in the previous part. And then share call is what was not paid. So share call account was created because it is an asset or it is a receivable, but now we are not going to get it and we are canceling the shares. So that's why we'll close that account by crediting it. So if you just look at all the entries, it's just a reverse of what we have already done. So these two were credited. So now we are closing and we are debiting it. And share call was debited, so now we are closing it by crediting it. And share forfeiture is naturally whatever was received by the company, whatever was paid up by the shareholders. So that is just an extra money for the company. Okay, so the last concept here is reissue of forfeited shares. So shares may be cancelled, like what we saw before, and then they may be reissued at a later stage to some new shareholder. Now they could be reissued at par, premium, or discount. So par means face value, premium is naturally at an extra amount, a little more than the face value, and discount is less than the face value. Usually they're issued at a discount. What you have to keep in mind is maximum discount allowable is the forfeited amount. So let's look at this example. Now let's say 200 shares of 10 were forfeited because only 600 was received. So 210 is 2000. So 2000 is the actual amount that the company should have gotten, but it has received only 600. So that's why they're going to forfeit. Now the 600 is like an income to the company. So it'll just remain with the company. Now if the company reissues these shares, they cannot allow a discount more than 600. Okay, so the maximum discount is 600. So let's say if they were reissued at 1800 as fully paid. So what this means is they're reissuing the shares at 9 per share. So 9 rupees into 200 shares will be 1800. So now what's happening is they're reissuing at just 1800, which means that is the amount they get. So you debit bank to 1800, debit what comes in. Now, share forfeiture account was credited when these shares were forfeited, and that has a balance of 600. Now, from that one, we are using the discount used. So the discount allowed here is 200 because the shares value is 2000, right? But we are issuing at 1800. So the remaining 200 should be given to the share forfeiture account. And then finally, you credit the share capital to 2000 because the shares are fully paid. Okay, now share forfeiture account had a balance of 600, but now we have used 200 as the discount, which means 400 remains. That 400 will be transferred to the capital reserve. So these are the main important points you have to keep in mind at this stage. I suggest you to watch this video a couple of times just to make sure that everything is clear, because so many things may get confusing, but they're all pretty simple. Just try to understand why each entry is given, and it should all be clear because I've explained as to why you're giving a debit or why you're giving a credit and how you're reversing it and all that. But still, if you have any questions, do not hesitate to ask me in the comments and I'll get back to you. And again, when we do problems, we'll do a couple of problems, and with that, it should be completely clear. But anyway, thank you so much for watching. I hope you liked it and found it helpful. Make sure you subscribe if you still haven't, and I will see you in my next one.